Hey, everybody. It's me, Alex, over here at Jet Lending. And today I'm going to go over an educational video on how long term asset based lending works. Now, what is that? Well, a lot of you guys already know if you're investors, you can use asset based lending, or what's more commonly termed as hard money, to buy, fix up the property, and sell it. But a lot of people still don't know that you could buy, fix up a property, and rent it with a 30-year asset-based loan. You could buy properties with a straight rate and term 30-year loan. You can buy mixed use properties. You can do commercial properties. You can do residential properties. You can do almost any property that is not owner occupied. That means it's for investment purposes on a 30-year loan that's asset based. Why do people do that? Well, if you want, and it used to be this case in the past, if you wanted a cheaper rate, you'd go conventional. You put 20% down, and you could talk about rates last year, but normally you were in the fours or the fives, and everything was cheaper, but it was very difficult to do. You had to have 6 months of principal, interest, taxes, insurance for each property. You could only do 9 plus your homestead, and then you had to refi that portfolio out with a conventional, with like maybe a regional bank or someone like me for asset based. But what's going on today, and the reason why I'm talking to you guys about this, is the conventional rates are almost the same as the asset based rates. So you are going to be looking at 30-year loans in the high sixes, mid sevens, and low eights, depending on the DSCR, the debt service coverage ratio. And the debt service coverage ratio is basically a relationship, and I'm going to show you the math so you guys can see it in real time. We're going to do a deal together, okay? But it's the relationship between your mortgage, which is your principal, your interest, your taxes, your insurance, and any association, just like homeowners association. Those 5 things is your mortgage. So let's say those 5 things was $1,000 a month. Well, if you rent your property for $1,200 a month, 1,200 times divided by 1,000 is 1.2. So it's a 1.2% ratio. That means the property covers itself 100% plus 20%. So you're 20% above your mortgage. So that's why you can do asset-based lending, because the property stabilizes itself. These are not income loans. These are not debt-to-income loans. That's why you'll have, how did that investor buy 14 or 20 or 30 rentals in a year? Because they didn't have to have the income per property. The property's still a loan. Now, are there requirements? Yes. You have to have at least a 660 credit score, or somebody in your LLC has to have at least a 660 credit score. The property value has to be at least worth $75,000. Okay. You can't do any mobile homes with 30-year long-term or manufactured. And rural areas are a little bit more difficult. Okay. Because no lender really holds 30-year paper. They get sold off into like security blocks. Okay. So the bank originates the loan, and then they kind of sell them off in blocks and notes, insurance companies, securities, and things like that. Okay, so there's a little bit of matrix that you have to contend to. So that's why you get with people like us to kind of evaluate it within 24 hours. Say, yeah, you're totally good. Something we can do. Go for it. Or no, we can't do this one. Okay, and when the ones you can't do, the best option is to go to like local and regional banks and credit unions and start a relationship with them. If you're in like the mobile home space, the RV space, a lot of rural, those banks are going to be very, very interested in lending to you, because they have to lend to their region. Regional banks, regional credit unions. Okay. So we're not only just here to do loans for you. Don't get me wrong. I wish I could lend you all money and take all, do all your business. I understand I won't get all your business, but what I will promise you is that I'll educate you and see when it's right to use me or somebody like me and when it's not. Okay. So let me show you the math. Okay. Because what do we know about investment real estate? It's just math. There's no emotion to this. Okay. If you do your math and you are in the black, you buy that property in regards to the return you have projected. If you're like, well, I need to make at least a 20% cash on cash return, and you do your math and it's 20%, guess what you do? You buy that property. If you do the math and it's not in accordance with your business plan on growth and margin, then you don't buy that property. Okay. So we just did an exit strategy webinar on owner finance too. A lot of different exit strategies that you guys can contend with. But this exit strategy class today is going to be for long-term lending. So we're going to do this first as if you were buying a distressed piece of property and then fixing it and then refinancing it. Okay. So, and I'll put the comments on, especially if you guys want to ask any questions or anything like that. You're always going to ask me questions. If you guys feel shy about asking questions, you can call me later or text me or whatever you need to do, or email me at alex@jetlending.com. But, if something that, you actually have something that you want me to go over, I'll always go over for you. An educated investor makes better decisions. If I can get you guys to start making better decisions, I can lend you more money. If I lend you more money, I make more money. If I lend you more money, you make more money. It's win-win. It always has to be win-win. All right, so let's start this. So purchase price. Let's put this as a rental in like a reasonable market in Houston right now. Let's say you're buying this for about $205,000. Okay, let's say the property is worth, let's say it's pretty banged up. Let's say the property is worth about $315 fixed up. But you need to put about 35 into it to make it worth $315. It's not too bad. You're doing some cosmetics and maybe changing your roof out and stuff like that. Taxes, let's put it at $315. 15 times 3.5% puts you at about $11,025. Okay. So on your hard money loan, the short-term hard money loan, I should say, let's put you at 3 points at 11.9. That is about average in what you're seeing in any hard money lender market. Don't get fooled by teasers. Okay. Then say that, well, I'll do 75% of loan to value. Do they have a loan to cost rider? Are they true loan to value? I'm going off a loan to value because that's how I lend. Okay. So I have to do it. I'm going to do it this way. So, I'm going to lend you 70% of the 315. So I'm going to lend you 70% of the after repaired value. So it's not what you did yet. It's projected. Okay. We're going to, comp it for you. You'll get appraisals, things like that, and say, okay, this is what it looks like it's projected. If you ever run into a lender that doesn't require appraisals, I still strongly suggest that you get one because it's a snapshot into the future of the consumer market. And your long-term loans are heavily based off the appraisal, since the money is coming from insurance companies and securitized markets. They don't understand the investment world. So they do matrix out a lot like conventional, though it's easier to do. So they're going to hold your value on rent and property value. The appraisal's like the gospel. Okay. So you have to make sure what it's projecting per the finishes that you're doing. A lot of times landlord investors get burned because they'll buy a property and an agent or a wholesaler or their cousin or whoever will tell them, oh man, that property's worth $410. Yeah, if you do $80,000 in repairs, but with the finishes you're doing, it's going to be worth this because the finishes of the property and how it looks and stuff like that dictates projected market value. Okay. So that means I'm lending you $218,500. That's 70% of the $315. Okay. I got to hold in escrow your repairs. Make sure your lenders hold your repairs in escrow. Why? Okay. Because when you ask for a draw, your money is waiting for you to get reimbursed. That means I took the money from my bank line and I held it in another account for you for your property. If you're not paying interest on your repair draws, ask them if your funds are held in escrow to make sure your deal has the money to deploy for your draws. If If everybody remembers 2016, and maybe some of you guys don't, there was an issue with some people. Okay, so make sure you got your repairs in escrow. Okay, so that means for a jet, your origination fee would be $6,555 because it's 3% of the 218. You got to pay the attorneys to draw the docs for your closing. You only pay for that if you close. We project a 1.5% fee for title. We won't know this until the settlement statement comes out, but we let you know, by the way, you're going to have title fees. So make sure you project this, okay? You may have a deal with a title company that says, hey, I do so much business, don't worry about it. But I'm going to say, well, just in case, you need to know. Processing fees, that's what I pay my processors to pull in your flood certs and your tax certs and all your stuff that you need for closing. Okay, again, that only happens if you close. So that means your total closing cost is $11,187. You're coming out of pocket 30 grand at closing. Why? Okay, so just to let you guys know, as a loan to value lender, you can come out of pocket zero. And how you do that is that I'm lending $218,500 for the total loan, but I'm funding $185,500 at closing because it's $218,500 minus your repairs. 70% ARV minus repairs is what I fund. That's why a good rule of thumb, if you wanted to be $0 out of pocket at closing, you would buy this at 65% ARV minus your repairs. So let's do that just to kind of show you what that looks like so we can move on to the long term. So $218,500 times 65% is $142.25 minus $35,000 is $107.25. Okay, so I did make sure I did that right. 315 times 65%. Oh, sorry, I did the wrong number. 315 times 65% is 204,750 minus 35,000. I was like, when I saw that, I was like, that's not right. It's 169,750. So I'm just going to put that number in there. So if you bought this for 169,750, you'll notice it right down now is green. That means I can roll in all your closing costs. That's how people come out of pocket zero. They buy it deeper. So when you have that, I can do $0 out of pocket at closing, that's what we mean. You're buying it lower than I'm funding at closing, so I can roll in all your costs, your title costs, your lender costs, anything like that, okay? But let's keep this at like the 205 number. Just wanted to make sure you guys were aware of that, okay? Because this is a long-term education, okay? All right. Well, sir, ma'am, you closed. Congratulations. Handshake. Now go fix it. All right. So you're fixing the property. You did a great job. Now it's time to refinance. Okay. So you refinance at 75%. I just lent you 70. Okay. So that means you have a 5% buffer on the back end. All right. If you season the property enough, over 6 months, you can actually cash out, okay? But you have to have a tenant in place or a lease agreement in place to do so, okay? So just remember that there is a seasoning requirement for cash outs. You have to own the property a certain amount of time, okay? So we have to pay this. You'll see lien and purchase price. So, because we can do rate and term too, but we have to refinance out. That means like if you use jet lending, you got to pay my $218,500 back on the refi. You got to pay me off because I'm a lien holder. So I always put about vacancy and maintenance about 20%. That is a business decision. Some people do 18, some people do 25. It's really up to you. And I'll tell you why I'm putting this in there. It has nothing to do with your loan. It has to do with your profit margins. I'm going to put about 20% vacancy and maintenance that you hold back in your profits to see, if there's vacancy, you got money in there to swing your note. Somebody moves out, you probably have to paint the walls, change the carpet. Did they take the stove? That kind of stuff. So 20%, you got your first out of pocket closing. We got to calculate that. I always like to calculate borrowers all in numbers. Okay. Are you still out of pocket on your refinance or not? Okay. So let's say we projected the rent in this area to be about $2,800 a month. Okay. I'm going to lend you 75% loan to value. Today, the interest rates are going to be in the very high sixes to low eights. And the funny thing is, your conventional lending is not that much different. So in the past, there always was that argument that was, okay, well, conventional is so much cheaper. Well, right now, if you guys are watching this, this is what? June 2nd of 23. So if you're watching this and it's August 4th of 24, just know that time has passed, okay? But the math's still sound. So let's say your interest rate is about 7.8%. And this is a 30-year term. And let's say this appreciates 5% a year, which is pretty conservative now, because I don't want to use the last 3 years where it was 19, 18. Basically, from 2019 to the middle of 2022, Houston appreciated about 40%. Okay, that's not normal. Okay, but a 3 to 9% appreciation, yeah. Okay, so let's use 5. All right. So right now with these numbers, I'm going to show you how things change. With these numbers, I'm paying off your 218.5 loan. Okay, with your principal, your interest, your taxes, and your insurance, you have a 1.02% debt service coverage ratio. 1.00 is the bare minimum. So you are just passing on debt service coverage ratio if this thing rents for $2,800. Okay, this is why people come to us, so we let them know what's going on before they get in too deep. Okay, so if you did this deal, you would make $53 in cash flow. Okay, and people are like, ugh. Well, one of the things you have to consider when you buy investment real estate for long term, remember, cash flow is icing on the cake. Okay, it is extra, at least into my opinion, because the real reason why you buy it is what I'm going to go over next. It's called appreciation. Okay, your return on investment cash on cash is about 5%. Okay, your net income year one is $509.74. If you bought this house this way, you can see I just picked out some numbers. Okay, but I want you guys to be aware of how to do this, so you can see if this is a good investment for your business plan. Equity growth in 30 years, $472,000. See the difference? People buy rentals, not for cash flow. I know there's a lot of different type of gurus out there. It's like, well, buy 10 houses and live for free. Like, no. There's a bunch of things you're always going to have to do to that house. You're buying that house because 10, 15, 20, 30 years from now, that house is worth so much more. I know some of you guys that remember, like, 1999. You're like, oh man, I missed the appreciation wave. Okay, well, what happened last year? What happens every year, especially in Texas? All right, so the cash flow over 30 years is about 20 grand, but your estimated profit over 30 years is $802,000 for one property. Now add 10 of them. Can you see what I mean by wealth instead of, there's a difference between rich and there's a difference between wealthy. Okay, wealthy means you don't really got to do anything. Okay, rich means that you're working and you're getting paid well for a job. When you hold assets like this, that's wealth. That's where you're coming from. The value of the property. You're paying down the principal balance every year. That equity is growing every year. You're refinancing and buy apartment complexes or RV parks or whatever. You're using these assets. Now here I'm going to show you something to watch for. Notice this point here says flood insurance. If you buy a property in a floodplain or it has flooded, it changes your number, because remember, you have to escrow for that. You have to put it in your mortgage. So let's say flood insurance on a property that's flooded was $6,000 a year. Our DSCR now went to 0.86. You have to buy that differently now, okay, because you need at least a 1.0. If you have a lender that'll do that, the rate's probably going to go up. But just make sure, so one variable changes, make sure to look at all variables. All right, let's say there wasn't a flood. It wasn't in a floodplain or it wasn't flooded. You didn't have flood insurance. It's zero. Go back to 1.2. But you bought in a property that has an HOA and it's $50 a month. Well, you got to pay that. DSCR went to 1.0. You're just passing. So you look at all this stuff and you're like, okay, well, I passed. All right, great. The appraisal comes in. Like I told you before, the appraisal is like gospel. Okay. So be prepared with comps to produce an argument, but it's very difficult to change an appraiser's opinion of value. Okay. I'm not saying you don't have an argument. I'm saying it's a difficult argument. Okay. Especially in the long-term sense of things. Short-term is a lot more because it's theoretical. It's speculative. It's like, well, they're got to do this. So it seems reasonable that it would be worth X. Now all the repairs have been done. It's finite. Okay. So be aware of that. So let's say you go back and the value comes in at, and I'm always going to do like the worst case scenario type of stuff for you. I'm not going to just butter you up and tell you what you want to hear. Let's say now this comes in at $295. Okay. On the value, and that's 75%, $295. It's still working. Okay. But you can see that some of the numbers have shifted. Okay. Your out-of-pocket expenses have shifted. So that is what I'm here to show you, is that you can do this. This isn't hard. This isn't mystical. Okay. It's just math. And I know that you're like, well, you do it every day. Like, yeah, I've done it for the last 10 years. Okay. But if you need help, get a good lender is going to walk you through it. And a good lender is going to be like, okay, this is what's going on and this is what you can do. And you're going to ask a question and you're like, they're going to be like, I don't know. I got to look that up. You know, it's like you're working in collaboration. Any of your lenders and third-party associates for like repairs or title company, remember, we're working for you. You interview us like you're hiring an employee. Do we work well together? Okay. You'll notice that maybe you interview people and you find out that you don't. Okay. And then you move on to other things. But, interview us. Like, are we the right fit? We're we never want to give anyone bad information, but you got to understand that if we think you're in danger, we're going to let you know. Doesn't mean we won't close on the loan for you if you want to take the risk, but you need to be aware of what's going on. And doesn't mean we're right and doesn't mean we're wrong, but we've done over 4,000 loans. We've lent quite a bit of money out over the last 19 years. In January, we'll be open for 20 years. We just want you to be successful, and we want you to be able to be protected as best we can, because in investments and in real estate, it's really subject to the market and how it changes over time. So you analyze and you do the best you can on values and things like that, but you can't project everything. Okay. So you got to learn how to pivot. And that's why we do classes like this, to teach you different exit strategies, just like we did the owner finance. Owner finance is a different exit strategy. Refinancing on a DSCR loan, what I'm talking about today, different exit strategy. Selling it, exit strategy. Subject twos, all that. I don't want you to feel like you have to be this jack of all trades, but what you can do is find gatekeepers of information and utilize their knowledge to see how you can best position yourself in any market. In transitioning markets like you're in today, these are the times where you're going to see the most millionaires made. The ones that are going to be able to transition. Everybody thought it was like the last 3 years. In fact, the last 3 years is probably one of the most difficult times, when it's very much a seller's market, and yeah, you can do anything you want, but you got to buy them harder. It's the people that know how to pivot during transitions. You guys are going to clean up, okay, which is going to be pretty nice. So I hope this helped. If it didn't, tell me why. If you have any questions, let me know. If you want me to cover any other topics, let me know. You can put it in the this is being broadcasted on every social media channel besides Instagram, because you can't broadcast on Instagram. But comment below. email me at alex@jetlending.com. You can text me. The number's on the website. Go to the website. There's a chat function. We've left every opportunity that we can to educate you. On our website, there's an education page with all these videos on it. You can watch them and have a great time. All right. So let me know what we can do. I hope this helped. I hope this sparked idea and thought. Okay. Because this was not all encumbrances. There's so many different variables that we can go over, and x plus y equals z, all that kind of stuff. This was to inspire some knowledge and thought. If you have that question or you need that help, get with us. We'll be happy to help you. I hope you guys have a great day. It's going to be a beautiful, it doesn't matter how hot it is. Just say it's beautiful. Beautiful day, okay? And it will be, all right? And you're going to have a great day no matter what happens. Let me know if you need anything, and we'll be there for you. Talk to you later.